If there's a drought in Kansas where they grow a lot of wheat, no one in New York skips eating their bagel. There's still demand for that wheat. And that's why there's very low correlation of agricultural commodities to the stock market. Ags don't care what the economy is doing. There's no doubt that agriculture is a good diversifier. And historically, again, since 2012, since the TAGS index has been in existence, the S&P 500 has pulled back 7 times more than 10%, and 7 out of 7 times that index, that agricultural index, has outperformed it. And sometimes it's been up when the S&P's been down, sometimes very significantly, like through COVID. So it is something investors should be looking.
Hello and welcome to the Achieving Alpha podcast. My name is Steven and I am the host of the show. Today, I'm delighted to be joined by Sal Gilbertie. He is the CEO of Teucrium Trading, which is a suite of ETFs which are involved in the agriculture sector. So I'm really pleased today to be doing a specific episode on something which I think is very overlooked, and that is agriculture. So pleasure to have you on, Sal. How are you today?
I'm very well, and thank you, Steven. It's really a pleasure to be here and to talk about agriculture. You're right. People don't think about it enough.
Yes, you're right. It's a very overlooked sector, but obviously it affects our everyday lives. We all need to eat. We all need wheat. We need corn. We need soybeans. We definitely need sugar in this day and age. And there's a lot of different areas which we need it in our everyday life. So it's really good that we can do a specific topic on it. As it's your first time on the podcast, I like to ask my guests to give a little bit of a background into them. And I wanted to ask you as well how you got into investing and specifically how you got into the agricultural sector.
Sure. So, wow, that goes way back. But when I was in college, I was fascinated with trading. And the day I turned 18, I opened a stock account. In those days, there weren't options yet. There were warrants on stocks. And I'll never forget, I bought warrants on Caesar's World, which was the only gambling stock trading at the time. And they doubled in 11 days, the worst possible thing that could happen to anyone. So I thought it was easy. And I got into investing, kept up. And in college, I interviewed with Cargill and was hired by them right out of school to be an oil trader, answering to their headquarters, or the oil headquarters was in Geneva. But I did go through the corporate, we call it the corporate brainwashing, but it was the best education I ever had, being in Minnetonka, Minnesota, and learning how to do things. They sent you to Iowa to a grain elevator to trade. You did all kinds of amazing things. I got a tremendous, wonderful commodities education at Cargill. And from that point on, I was at Cargill. I left there and was always in either oil or agricultural trading. Took me in the early 2000s to SocGen, where I heard George Bush II, George Bush Jr., give the speech about ethanol. I didn't even know what ethanol was. And because I had blended gasoline for Cargill way back when and taken them actually from leaded to unleaded, I realized that this was the future of gasoline blending. Ethanol was the way forward. I wrote a swap and got that going, and it turned into a massive liquidity desk at SocGen, market making for, at one point, over 30 commodities. I hired my old boss from Bear Stearns, just had a really good time doing those things. And then I found out about ETFs, and I didn't know what they were. And I was stunned because of my career trading futures or physical commodities for the house all the time. I couldn't buy or sell oil, for instance. If I thought oil was going up, I had to buy or sell Exxon or Mobil. They were actually separate companies at the time. And this guy was downstairs in a SocGen brokerage office talking about opening an ETF with oil futures in it. And I was stunned. I couldn't believe that you could buy something on the New York Stock Exchange with commodities in it. I thought it was a brilliant idea. I thought I could make a better oil ETF, which I did. I thought I could make a better natural gas ETF, which I did. And there were no grains ETFs. Turns out in the ETF world, unless you're first, no one buys your fund. And so we closed the oil fund and closed the ETF, the natural gas ETF, but kept open the big ags. We had corn, soybeans, wheat, and sugar, and then a fund of funds. And so we became known as the agricultural people, but known for our commodities expertise, as people may or may not know. And here we are.
Did I get it right from, I think I saw in a previous interview that you actually grew up on a farm as well, and that you were involved with?
I did. I'm actually sitting on a farm right now. So I'm sitting on a certified organic 32 acre herb farm right now in Connecticut that's run by my family. Yes, that's right. That's where I keep my office. But yeah, keep my office here.
So you were always quite close to the sector, even growing up.
Always. In fact, behind me, I don't know if you can see the small ears of corn. I grew some. I like growing the heirloom variety. So we grew some heirloom popcorn from a. This popcorn was discovered 600 in a 600-year-old jar in New Mexico. Somebody germinated it in some university. I got some seeds and we grew it. It works. Throw it in the microwave and it works. Yeah, it's good fun. Agriculture is good fun.
Nice. Sounds really fun. Okay, and I wanted to ask you, why is it important, do you think, in this day and age where we have all different types of options for people to be able to buy stocks, commodities, cryptocurrencies, whatever that might be? Why do you think it's important to have commodities in a portfolio?
Well, there are a variety of reasons, but one, if you go way back to Peter Lynch, who said, "Buy if you shop in Walmart, buy Walmart stock." That's what he always used to say. And everybody knows agriculture. They have no idea how much agriculture touches their lives. And okay, pretty basic concepts. All right, if there's a drought in Kansas where they grow a lot of wheat, no one in New York skips eating their bagel. There's still demand for that wheat, and that's why there's very low correlation of agricultural commodities to the stock market. Ags don't care what the economy's doing. They don't care who the president is. They don't care what the latest version of the iPhone is. If you're still going to eat that bagel. And so if the stock market's crashing, you're going to eat a bagel that day before you go in the office and look at your 401k. And you probably are going to wish your 401k were more diversified. If it had agriculture in it and commodities in general, it would be more diversified. And a lot of times agriculture zigs when the stock market zags, and very often stock market on big down days, of course, everything correlates. But on these small down days where stock market's down 1 or 2% on some headline news, very often ags are up, and the risk adjusted return of a portfolio with an agriculture or commodities component is actually better. And again, that's the risk adjusted return. The absolute stocks always go up. They go up because of all the stimulus that's been happening. Who knows if that'll continue? But if you're just investing 100% in stocks win. If you want a risk adjusted return that is more moderate and more predictable and lets you sleep a little bit better at night, you really should have a balanced portfolio, and commodities should be a part of that.
Yeah, and on a balanced portfolio, obviously we mentioned that we should have some commodities exposure in people's portfolios. Obviously, there's so many different commodities out there. I think when people think commodities, they automatically think gold, silver, oil, maybe, and less so about agriculture. When there's so many options out there, how can an investor make sure that they're invested in different areas and different commodities? Is it just about, for example, the way that you do the weighting?
It can be. I think that every investor should probably start with a multi commodity index that they gain access to, probably through an ETF. That's the easiest way. I mean, if you're talking about institutions, they can call their bank and get exposure to whatever they want. But real people, real investors, institutional or registered investment advisors that are advising people, retail advisors, and even retail traders themselves, they have access to everything now through ETFs. And so you pick a good multi-commodity ETF, put 5 or 10% weighting in that. That's a good start. And then you've got to overweight or underweight. And a lot of people know oil. A lot of people know gold, and you're absolutely correct. That's what they think of when they think of commodities. But an interesting thing, and not to jump ahead or get too far in the weeds of wherever you want to go here, Stephen, but we've Market Watch ran a headline not long ago that said corn under $4 a bushel is equivalent to oil under $40 a bushel, a barrel. And so when oil goes under $50 or $40 a barrel, the amount of money that pours into the oil ETFs, that pours into the oil market in general, people add oil into their portfolio because they say, wow, I know that's around the break even of oil. I know oil at $40 is a bargain, because at some point in the future, geopolitics and simple supply and demand will make oil go back up to 60 or 80 or even $100. The number of people that know that and act on that premise is quite astounding. And they don't know that about corn. Well, guess what? In the last 17 years, corn has doubled 3 times from the roughly $3.50, $3.75 area bushel, and then go back down. So if somebody says to you, I have an asset that trades at X because that's its break even, has very little downside historically from X, and has doubled 3 times in the last 17 years. And by the way, it's headed back down toward X. Everybody you talk to says, "Wow, let me know when that thing gets to X. I'll throw a little money in there." Well, that's corn. That's corn. That's what happens in the corn markets. That's what happens in the oil markets. If gold ever went back down below whatever they think break even is now, people would load up on it. People do load up on oil. Why don't they load up on corn? It's a huge market. No single investor could. I mean, it trades decabillions a day, notional value. So the corn markets are gigantic. The soybean markets are gigantic. The wheat markets are gigantic. Some people say wheat is more political and more of a known commodity than oil in the world. And yet, when the price of wheat gets down toward its break even, nobody cares. Nobody even knows. So yeah, that's why we're here. We're here to provide access to those markets and education as well.
Yeah, and I noticed as well that you have the individual ETFs for corn, wheat, soybeans, sugar, etc. But you also have a kind of a diversified agricultural ETF. Does that cover all different commodities in the agriculture space?
It does not. It just covers those big four: corn, soybeans, wheat, and sugar. So we have two of them. One is called tags, and that is the Teucrium Agricultural Fund. And it's a fund of funds. It buys each of our other ETFs, corn, soybeans, wheat, and sugar, in a 25% weighting. The other one is called TIL, and it just buys the straight futures. It's not a fund of funds. It's slightly different, but they both behave the same way. They move with those four commodities. Here's the thing. The tags index, since it was started in 2012, the S&P 500 since 2012 has had 7 corrections of 10% or more. In all 7 of those times, the tag index has outperformed, sometimes very substantially, the S&P 500. So to your original point where we opened up the show, there's no doubt that agriculture is a good diversifier. And historically, again, since 2012, since the tags index has been in existence, the S&P 500 has pulled back 7 times more than 10%, and 7 out of 7 times that agricultural index has outperformed it. And sometimes it's been up when the S&P's been down, sometimes very significantly, like through COVID. So it is something investors should be looking at. They should be looking when commodities are very cyclical, when commodities are cycling no, and you don't have to be an expert. Look at a chart, things trading long-term flat line on the lower end of their range, their long-term range. That's when is probably a good time to really look hard at diversifying your portfolio and adding some agricultural commodities. It does work. It has worked in the past very well.
Yeah. Okay. And for people that aren't that familiar with agriculture, can you just explain some of the dynamics that are in play that affect the price of agriculture, whether that be weather, supply, demand? Yeah. Can you just explain a little bit?
It's all the above. So yeah, agriculture is completely contingent on weather. I'll just use the combined use of corn, soybeans, and wheat. The global combined use of corn, soybeans, and wheat is either a record or a second highest record. It's either the highest or the second highest in history every year since 1960. So every year for the last 65 years, the combined use of corn, soybeans, and wheat goes higher, or it misses just by a hair. Okay, so that shows you that demand is constant and increasing. When you get bad weather, that's the number one thing that influences volatility, I would say, in agricultural markets. You harm the supply. So when you've got steady or growing demand and supply that's erratic, you get price volatility and you get monster price spikes. That's what has happened. That's what happened those 3 times in the corn market that I've referenced before. That's what's happened in cocoa. Okay, cocoa, you've had 2 years in a row of really bad weather where 70% of the world's cocoa grows. That's why the price of cocoa is going up. That's why the price of chocolate's going up. Okay, that's a very big deal. Those are the core premises of ags. Ags and the big industrial ags like corn are used in everything. So it's not just people think of corn, they think of eating corn. That is literally doesn't even make the pie chart of corn use. So corn globally, the number one use is to feed animals. So if you're eating any animal product whatsoever, you are indirectly consuming corn. All right. The number 2 use is to produce ethanol, so it goes in the fuel supply. The number 3 use is starch. And if you use paper, it's held together with starch. So, I mean, it is impossible to not use corn. If you're drinking any kind of sweetened drink, it's probably been sweetened with corn syrup. So there's no way anywhere in the world for you to not use corn directly or indirectly. That's just one example. Soybeans are the same way. They feed animals, they feed people, and they're used in the fuel supply. Wheat feeds people. It's a global commodity that gets the headlines. I mean, our wheat ETF, that it went up by a factor of 10 when Russia invaded Ukraine. It had about 85 million in it, and after the war started, it went to 800 million. Money poured into those markets. But again, headlines brought people's attention to ags, and people should be thinking about ags all the time. They use them all the time, and when they cycle down, because every farmer in the world is subsidized by their government, okay, so they're used to operating at break even, which means the natural price state of an agricultural product, all else being equal, is break even. You have limited downside by virtue of the fact that it's trading at a break even price, and farmers will stop planting whatever that crop is. And so when you see crops flatlining again at their historically low price levels, if you look at long-term charts, that's when you really, really need to look at layering them into a portfolio to balance it out.
Yeah. Okay, and you briefly mentioned about what happened with the wheat prices during the Ukraine-Russia conflict. Can you just explain to the audience why that happened and why geopolitics does affect commodity prices, but in specifically agricultural products? Can you just explain a bit more?
Sure. Well, people have to eat. Yeah, people have to eat, and so when and understand almost, I think wheat is grown on almost every continent, maybe every continent, except I don't know, in the extreme polar regions. But it's mentioned 53 times in the Bible. Okay, wheat is a staple core food for human survival. That's what it is. And when most countries don't grow enough of their own, they have to import, and so 30% of the exportable wheat comes out of Ukraine and Russia. So when those two countries go to war, that affects 30% of the exports. That is the food supply. Okay. So for instance, China is holding most of the world supply of I believe, soybeans, wheat, and maybe corn as well. They don't export. They only import. So we can look at the global balance sheet of agriculture and say, oh, there's plenty. But then you realize most of it is in China. Okay, China's holding half or more of those supplies. If there's a crop problem, the rest of the world won't have enough food to eat, okay, or the price of that food, because you always have enough because the price goes up and price rationing. But the people panic because grains are cyclical, okay? Every agricultural product, you have to plant it in the spring, wherever you are, wait for it to grow over the summer, and then harvest it. So you really only have it available post-harvest. So, and there's a big pile on the ground, all right? And you're taking out of that pile from the last day of harvest until the next first day of harvest. Nothing's being added to that pile. That's a year later, all right? So, and typically the world has about a 6-month supply of wheat on hand that's excess. Typically in corn, it's about 2 to 3 to 4 months. Soybeans, I think, is about the same as corn. And so when people start to say, well, wait a minute, the crop isn't growing very well, there's a drought or there's some kind of supply disruption, they realize at the end of the season, that pile's really small. We've got to add back to that pile. What if the fields aren't providing us enough to add back to that pile and make it as big as it was a year ago? So people panic. And that's why you see these big price spikes. If anything happens, like a war that affects the people who export these crops, then that's a problem. So wheat is grown everywhere. Corn is and soybeans are not grown in enough places for export. So in other words, soybeans, there are only two meaningful exporters of soybeans in the world: Brazil and the United States, in that order. Argentina exports soybean products. So if you have Brazil, the United States, and Argentina, that's it. If you want soybeans, you can't really get them anywhere else. Paraguay will sell you some, but they barely have any. So compared to the global supply chain. So the bottom line is we're blessed in that the United States and Brazil are geographically gigantic. And so the weather would have to be bad throughout the entire growing area of those things for there really to be a supply disruption. But when you see a drought, say, in the northern half of Brazil, or a drought in the U.S. Midwest, that will impact global markets, because if you want to buy soybeans, you can only buy them from the United States or Brazil. That's it. And so That's why people panicked during the Russia-Ukraine war. 30% of the available exports were taken out. And by the way, Ukraine was a top 5 corn exporter. They were the number 1 corn exporter to China. So there was some panic there as well. That's why corn followed up.
Is that changed at all since that point, or is it still the major supplier of wheat?
It's so nothing has changed in terms of the amount of combined supply that Russia and Ukraine send out to the world. And in fact, the supply hasn't changed much. I mean, they're kind of, the war's having an effect in that this year, between weather and Russia drafting all its farmers, they're probably not going to produce as much wheat this year. There's still plenty. There's still projected to be plenty, but Russia will have significantly less wheat for export than it did, say, in the prior few years. And Russia was also exporting wheat that it had spoils of war. Basically, they invaded Ukraine, and whatever wheat they could find, they exported that as well. So no matter how you feel about it politically, it doesn't really matter that wheat was available for export. Whether Ukraine exported it because it was theirs or Russia exported it because they confiscated it and then exported it, it was still available to the rest of us, which from our perspective is a good thing. If you're eating your bagel, that's a good thing.
Yeah, of course. Okay, and obviously we've seen a lot of things happening at the moment with regards to tariffs, especially that have been placed from the US on other countries or being talked about being put in place at the moment. You have to think that there probably will be some reciprocal tariffs as well if the US does increase the tariffs on specific countries. How can you see that affecting the agricultural sector over the next short period?
Well, remember, we've seen this game before with Trump putting tariffs on our soybeans and our farm exports before in his first term. And what happened was, let's face it, the world needs all that's grown, no matter who grows it. It just means that the United States will be the exporter of last resort. So China will buy all of Brazil's soybeans before they buy soybeans from the United States. That's all that means. But eventually they will buy soybeans from the United States. So there's opportunity. All right. So if they do announce the tariffs and the tariffs are put in place, you will see an immediate decline in U.S. soybean prices and corn prices probably too, because people won't be able to buy them and the farmer gets discounted. Okay. So you'll see that go down. But what will happen is, just like happened last time, price of soybeans will go down. But Brazil will sell out all the soybeans. Argentina will sell out all their soybean products. Paraguay will sell all their soybeans. And everybody says, where can I buy soybeans? They come to the U.S., so the price will go back up. So there's real opportunity when there's government intervention of any kind in any market. Tariffs on agriculture are no different. If there are reciprocal tariffs that balance each other out, I would have to say everything will offset. It won't matter. You go straight back to supply and demand. But we've seen the game before. U.S. agricultural prices will take a dip. That will likely be an opportunity because people still need to buy from us. Everybody needs that food.
Yeah. Okay, that makes a lot of sense. With these, a lot of these things comes opportunity as well for certain countries. Okay, what I wanted to do now is I wanted to go through some of the different agricultural things. So if we start off with corn, so I'll just share my screen right now. So I wanted to start off with corn, and I was just wondering whether you could explain a little bit about why the price has taken the shape that it has over the last 5 years or so, and what has led to that.
Sure. So if you look at the lower left of this corner, that's corn trading around its break-even price, and that's the natural part where it would be. And there were some weather problems. So about 5 years ago, there were weather problems in China. China came to the global markets importing. It did cause a lot of strength. So you saw that initial run up there. And then, of course, you had the war. So when the war came, whatever that is, 2 years later, that really put the spike. So prices remained elevated because you had to rebuild stocks after the floods in China and them coming into the global markets to buy. And so then when the war broke out, you had wheat and the price of everything go up. And again, grains kind of track each other because it's a protein spread. If there's a certain amount of protein in wheat, there's a certain amount of protein in corn. Everything went up when the war came. And so you saw the peak shortly after the war commenced. And then when people realized that global supplies really weren't going to be affected by the war, we'd still have exports, you began this, in essence, 3-year downtrend where you are now. The global balance sheet of corn was projected it was tightening. It was tightening slowly. So this past summer, we're in March now when we record this, or February 28th, but 6-8 months ago, we saw the corn balance sheet tighten up. The corn crop was not quite as big as they expected in the United States. It was not quite as big as they expected around the world. And so we tightened and had this short term rally. This last brief bar down, we just had agricultural reports from the government estimating that there will be more than adequate corn supplies, that corn supplies are building. And so we see corn will likely head back towards its cost of production. So that's what I would think. I would think right now, as we head into planting season, if all goes well without a drought in the summer, we should see corn prices continue to head lower from there. Again, everything's very cyclical.
All right, excellent. And we'll move on now to wheat.
All right. Wheat's the same thing. Sure. Wheat, absolutely. Wheat was trading at that break even level, and it was headed up slightly, that uptrend to the build up towards the war. And again, that's from China. China had a problem. They were importing, but China has a lot of places to buy wheat from. Again, there are a lot more wheat exporting countries than there are corn and soybean exporting countries. And so you saw it more rational price rise there. But again, things at their cost of production, they have very limited downside. At any blip, and with that growing demand, things and they spiked. Of course, you saw that massive spike right at the beginning of the war. People a little nervous till they realized imports could resume again, and things had backed down. And we're right now probably within 10 or 15% of the cost of production of wheat. So we've headed back down. Wheat had a little rally in the past month or 2 or 3 here, and that falling off again because of the recent agricultural reports that's following corn down. Wheat, I should note, has the most stable yet probably tightest balance sheet right now. And so there are plenty of soybeans in the world. There's plenty of corn and predicted to be more. Wheat's holding steady. So I wouldn't expect wheat to have as much as a pullback from current levels as corn. And I would expect people to start accumulating wheat for their longer term strategic investing portfolio, where it's a good it's a good way to diversify your portfolio, and you can get some limited downside based on historicals there.
All right. And I heard you before mention, I think it was on LinkedIn, you wrote, there was an article on there about something you mentioned called the golden grain cycle. And that you mentioned that it was in 3 stages. Could you just explain that a little bit more in depth to the audience?
Absolutely. And that's something that I would encourage people to search out and read, the Golden Grain Cycle, published by Teucrium. The first step is basically you're trading at break even. Okay. And because that's where the natural, as I said before, that's where the natural price range will be. Farmers are supported by their governments throughout the world, because you want to have enough food to eat or you lose power if you're a politician. And so you support your farmers. So farmers get used to being subsidized and surviving at a break-even price. That's stage 1. Stage 2 is when you have a price rise. Okay, so you have a price rise because of a supply disruption. Your demand, as we've said, is continually rising. It's in a long-term uptrend. And so when you have a blip in supply, prices will rise very, very quickly. Then every farmer in the world will plant that crop. Any farmer who can switch their crop to that crop will plant it. Any farmer who was planting that crop will plant as much as they can until the price gets back down. And so the price will head back down in the stage 3 when you head back down towards the cost of production. So you really want to keep your eye on ags. It's a really noticeable pattern in corn, but they all follow one another. When you're trading flatline at break even, that's stage 1. That's when you want to have an allocation into your portfolio, and just figure that one out for yourself, how you want it, and talk to your financial advisor. When it's headed up, we had a financial advisor call us. He said, look, when corn is down at break even, I put 1% of my portfolio in corn. When there's a drought, it goes up and it doubles and I get out. And he said, here's how I look at it. If I buy 1% of something that probably has a 10% downside because I'm buying it at its break-even price, client comes in, I've got 1% of my portfolio in corn, it's going down 10%. That means it's affected my portfolio by 0.1%. They ask why it's in there. I say for diversification. And by the way, it could have some upside. He said, it goes up and doubles. My 1% went to 2%. Now my 9% target portfolio just went to a 10% target portfolio. I look like a genius. And then I just get out. So he said, I weight it into my portfolio, WEIGHT. I weight, WAIT, And then when there's a drought, I get out. So his slogan was wait, wait, drought out. We loved that. That was wonderful. Great strategy for him. I think everybody should probably have some version of that as a consideration for their portfolio, because grains are really, really, really predictable based on past performance, based on what we know about their current usage, and based upon the fact that weather's volatile and it does affect the production of these big grains.
Yeah. As you mentioned, obviously it's quite cyclical, right? Things usually, it kind of fits in with a usual pattern. But I guess that over the long term dynamics is the global population has been going up, and there's more and more requirement for wheat, soybean, grains, sugar.
It's exactly right. And it's twofold. It's the global population going up and the global middle class expanding. So the what happens is people who are not in the middle class, and that's a shrinking number of people, which is wonderful to see. But the people who are dirt poor, basically sustenance living, the first thing they do when they get any disposable income, and you can look, there are multiple studies on this by the UN, by universities, is add meat to their diet. They add animal-based protein to their diet, and that directly that's the number one use of corn. It's the number one use of most grains, is to feed animals. And so that's a start. And then with corn, again, in so many different things, from your fuel supply to your paper to sugar, it just, as the global middle class expands and people use more and more stuff, and industrial uses for these agricultural products expand, the demand just keeps going higher. You're exactly right. And weather is volatile. Weather remains volatile. You need massive amounts of land to grow these big crops. There's no way to shield it from weather. No way.
Okay. All right. And what's the biggest challenge facing the agricultural market at the moment?
I I think keeping up. I think that we've seen wonderfully between genetically modified crops and just the tremendous technological developments between. I mean, sounds as simple. Guy won the Nobel Prize for developing chemical fertilizer. Okay, just nitrogen based fertilizer out of natural gas. That has helped. That has kept billions of people alive. That has enabled us to feed billions of people. I think production keeping up with demand is the greatest single continuous challenge to agriculture. And of course, there's weather, but you could have perfect weather, and unless you make seeds that are going to produce more, okay, unless you have sophisticated tractors. Now they use drones to monitor their fields and fertilize, and it's astounding the technology that's out there that's adding to production levels. If we didn't have that, people would starve, literally. And so the greatest challenge is keeping up with rising demand. That is the greatest single challenge to agriculture.
Sal, I wanted to ask you a question as well, which might be a little bit difficult to answer. So take your time to think about it. But what kind of one prediction that you would have in terms of the agricultural sector that others might not be thinking? So something a little bit contrarian, something that's kind of against the grain, excuse the pun.
Yeah, that's actually a great question. I would say that all of the, because I say it all the time, all of the money that's being poured into alternative production. So producing meat in a petri dish, trying to get people to eat insects. All these things that are feasible, that are being done on some scale, especially out of Israel. They're leading everybody in this kind of stuff. I don't think it's going to be as big or as fast as people think. We saw all this money rush into indoor agriculture to grow lettuce, let's just say, in glass greenhouses. Well, to implement all the new technologies and do all that stuff, it costs hundreds of millions of dollars that were invested. And lettuce sells for $2 a carton in the United States. I mean, that's what it does. So when you do the math, you look at it and say, well, how much lettuce are people going to eat to get the volumes up to pay for those things? And son of a gun, they all have filed for bankruptcy. I mean, all of them in the last 5 years, they went up and they went down. It's a boom and bust. So I would say the God bless all these people who are leading edge technology and pitching these wonderful ideas to produce food in alternative ways, or even alternative foods. But I would say that those things are going to take much, much longer to implement and to even just get people to accept than people realize. So that's my prediction. My prediction is all the newfangled stuff that is high tech and flashy and sexy, do for a PE person to maybe invest in. That's great, but don't bet the farm on it. and no pun intended there. Don't do it. Yeah.
Yeah. Wow, we got two puns within one question. Excellent. All right.
Yeah, we did.
In terms of the ETFs and futures, because obviously you can trade futures on these agricultural products, why should people use ETFs in order to get exposure to agriculture?
Because they can't trade futures. I mean, if you can trade futures, trade futures. Don't pay somebody else to trade them inside of an ETF for you. Just trade the futures yourself. But that's a highly specialized game, and many places, including institutions, just aren't allowed to have futures accounts. It's just easier to have something packaged up that you can buy and sell in an ETF. ETFs also, they provide non-institutional access to commodities that otherwise only professionals could get a hold of. So even your retail advisors, people who help hundreds of families manage billions of dollars collectively, they ETFs are just a perfect tool for them. They can get access to something easily without a whole lot of extra paperwork and complication. ETFs are a wonderful tool and way to access all kinds of markets easily. That's what ETFs do. Now, depending on what they hold and what your investment objectives are, that's a whole nother story. And you've got to be careful there and know how they act and what's inside them. But an ETF is a remarkable instrument. That's why they've gathered trillions of dollars. That's why they're gathering trillions away from their they're easy, they're cost effective, they're transparent. By law, you've got to know what's in it within 24 hours. It has to be posted on your website. There's nothing about an ETF that is non-transparent. It's wonderful. It's wonderful.
And do you notice from your customers that people are trading around the cyclical cycles of the agricultural products, the ETFs that you have? Or do you think, or a lot of people holding them kind of long term, just in order to have long term exposure?
I think it's both, but thankfully, I think more people are trading them cyclically. They're understanding that there's a time to really accumulate and build up a position in your portfolio, and there's a time to really lighten up that position in your portfolio. I mean, at all times they're gonna diversify. So a lot of people they'll wait X percent and then cut it back down to some small fraction of X percent when the prices are high, which just makes sense. But yeah, I think it's both. We have a lot of buy and holders who are that, but that's really just for diversification. If you're looking for both diversification and some alpha to actually make some money as well, agriculture is a really good thing to look at. It's cyclical, just like oil. Just like oil. If oil's down to $50 or $40, people buy it and they wait. Just like it, ags are the same way. It's the same concept.
And out of all of the agricultural ETFs, etc., that are available, what do you think, which commodity at the moment do you think has the best opportunity at the moment for where we are in that cycle? Because obviously they do change depending on what commodity they are. What do you personally think is the best opportunity right now?
Well, so of the big giant ones, I'd stay away from coffee just because it's weather contingent and it's elevated. I'd stay away from cocoa. It's weather contingent, it's elevated. I think the grains that are headed down toward their cost of production, I'd give it to wheat. I think wheat of all of them has potentially the tightest balance sheet, meaning that if there's a supply disruption of wheat in one of the major exporting countries, primarily through drought, that's going to affect the wheat markets more than any other market right now. If there's a supply disruption in, say, soybeans or corn, soybeans and corn, there's plenty of all of it. Okay. But wheat is getting towards where there's only enough. And so it still has some downside potential. Certainly it's not quite at its break even yet, but of all the big ones, I'm giving it to wheat. I lean towards wheat.
Not too far off. All right. Excellent. Okay. So, Sal, how can people find out a bit more about you and also find out more about Teucrium trading and your ETFs?
Sure. Well, the thing to do is go to teucrium.com. You can follow Teucrium on LinkedIn. You can follow Teucrium on X. You can follow me on X. It's my name backwards, Gilbertie Sal. But, at Teucrium, you can sign up for our newsletter. And again, we publish sometimes as much as twice a month, no more than that, and you'll get something in your inbox. We won't be calling you. You're safe to sign up for that. We also just came out with a commodities model. People have asked us because we know commodities. They say, look, I know I need commodities. I don't know what to overweight and underweight. Can you tell us? So you can go to teucrium.com and find your way to where you can sign up for our commodities model, which puts out signals once a month. And it just tells you which ETFs are in our model that we overweight or underweight. And they're not all our ETFs. We only have agricultural ETFs. So it's the whole commodity spectrum. If people are interested in commodities, we're here to help. We're interested in helping you and sharing our knowledge.
Excellent. And Sal has a lot of good resources on his LinkedIn as well as his X as well, which he regularly post different things on the agricultural market. So I suggest you check that out. I'll leave all the links below this video. But I've really enjoyed the chat today, Sal. It's been really good, been a good first glimpse into agriculture. And I hope some stage in the future you can come back and we can dig more into the weeds and go into a bit more depth.
As do I. Thank you, Steven. This has been really, really fun and always happy to do it. Always happy to be on the show. It's great.
Okay. Appreciate it, Sal. Thank you very much.
Thank you.